Hi, everybody. This is Bo Yoder here with Roger Corey. We're both managing partners at RBJ Financial Group. And we wanted to spend a little time here going over some of the foundational principles that produce the kind of accuracy in forecasting and profitability that our firm enjoys. Now, many of you will have seen us do some live forecasting, and what we wanted to do with this video is really show you how we can scale that down because for the time compression, we want to show you something over the course of a couple of hours and really make an impact on how the market, number one, isn't random and is quite forecastable and predictable. For a lot of people, that doesn't really resonate because many of you are busy with other lives. You're really not interested in watching the markets on an intraday basis. But we want you to understand is that principles in the market are universal and they can be universally applied. And one of the most important principles in any market interaction is risk management and risk control. And that's ironically a piece that really gets missed in the sort of standard institutional investing experience. Now, the reason for that is traditional institutional investors manage risk through broad diversification. I'm sure you've all heard that term. Essentially, buying little pieces of a lot of different kinds of investments on the hope that the gains and losses those investments experience will balance out over time. And the reason that they do this is because there is an institutional doctrine that says that the markets are random and that they're not predictable and you can't time the markets. I'm sure most people have heard that if you spent any time reading any of the standard investment literature. Well, we beg to differ. Our experience and our long experience in the markets, I've been trading pretty much everything that you see on this chart. I've been trading since the late 90s and Roger as well. Our experience tells us a very different story, that the markets are not random, they're cyclical, and the price cycles are not only forecastable, measurable, but accurate forecasts can be made at a level which would astonish many people who haven't experienced the kind of paradigm shift that we've gone through over our investing career. Now, Roger created a methodology, an instrument tool set that we use to measure and analyze the market forces of supply and demand, which drive price up and down. But what's interesting is, and this is really what we want you to get out of this video, is a perspective shift. Most people are always looking for opportunity in the markets. They're looking for the stock that's going to be the next big thing. They're looking for ways to make money in the markets, and we go about this a very different way. In fact, our proprietary tool set that we use is something that we call predictive failure technology. Our entire analysis methodology is based around avoiding losses, avoiding crashes, avoiding negative experiences, because we know that if you can avoid a lot of negative experiences, the positive experiences will compound radically and produce extraordinary results over time. So that shift in perspective is very, very important, and that's really what we want to walk you through today.
Now, speaking of perspective, let's talk about something that you've been raised with most of your life. And that is the concept of managing your money wisely. Now, what's interesting is that fundamentally sets you up for really mediocre results, if not poor results, over the life of your investing experience. And the reason for that is the inherent focus on making money will tend to blindside you from the inherent risks that you would otherwise be aware of. So what I've done is, in my own development process of creating the predictive failure technology and the methodology of how to engage and interact with the markets, I shifted my focus from looking for opportunities that are likely to make me money to instead look for opportunities that are not likely to lose me money. You see, everything shifts from that perspective, okay? You'll start to look at everything, every opportunity, very differently. Because now, instead of focusing on, well, what can that make me, I'm focusing on, rather, what are the risks? What can that lose me? When you start to look at all of the factors that begin to line up that help you understand the risks involved on the way to producing a potential reward, then you'll begin to see all the little cracks and gaps that are there for you to begin to more proficiently assess whether this is something that's going to fit your risk profile and whether that's going to be right for you in your particular circumstance or not. So by approaching the market with that fundamental shift in perspective, our objectives radically change. And that objective is no longer just to catch the next big high flyer or to make as much as I can out of the market, but instead be methodically moving into investments that will allow me to grow my capital with the least amount of risk. And when things begin to shift in terms of the risk profile, we want to begin to move back into safety. Now, a quick analogy would be you don't suddenly have a storm that suddenly just pops up over your head and starts dumping water and lightning and thunder. Usually you start to see clouds rolling in, right? And as those clouds are rolling in, you're beginning to get a sense, hey, the weather's changing. Things are cooling down. A storm may be brewing. And as the clouds get darker, you have time to prepare. And predictive failure technology focuses specifically on those shifting patterns and those cycles and the indications in the market that tell you, you know what, we're beginning to go into a very different type of a weather pattern financially, and that we should probably take some proactive steps to shelter ourselves from the potential coming storm.
There are cycles and seasons in every aspect of life. And it's always interesting to me that the cycles of planting and harvesting in the agriculture world are self-evident. But people don't realize that there are times to plant and there are times to harvest in the financial markets. And that's really what we want to make abundantly clear with this example as we go through several seasons here through almost 15 years worth of market experience, which is sort of typical of the retirement world, right? You have a 15 to 20 year career. We'd love to think that we could work for 15 years and then retire and go, live our life in any aspect of retirement that we would choose with the money and the resources to live that lifestyle that we would want after a long and hopefully productive career. But you can kind of see we've got three different clusters of seasonality here. And the thing that's really important to note is if you started off in the beginning here in 1997 with a $10,000 starting balance, which makes the math easy, you've experienced two 50% or more than 50% corrections during that time. You lost half your money twice. And there's really no reason why you'd have to experience that kind of pain and suffering. And I'm sure many of you can harken back and remember how uncomfortable and unpleasant that was. We feel all of our instrumentation is telling us that we're getting set up for another significant correction in the market as it stands today. And we want to make sure that this message can reach as many people as possible so that hopefully they can avoid that negative experience. So by showing you what happened in the past and how rhythmical and cyclical it is, we hope to make the point that we're at that point moving forward into the future, and you can thus learn from past mistakes, and that's really where true wisdom comes from.
Now, and that's a great point because most people don't realize if you get caught in a 50% downturn, you have to recognize the math of that, because if you lose half of your investment capital or your retirement account, the market has to double for you to just get back to break even. That is horrendous on your financial future.
And actually, just for quick dirty math, if you were to have entered in the peak of the '07, '08 markets and have taken that 56% drawdown, I think essentially you're up about 45, 46%. So you did get that drawdown taken care of, and you are actually making money. But look at how much time you lost. And there's also a thing that people don't talk about. Yes, we look at the long-term perspective when we're looking at retirement, but let's think about the cycles of the economy and the job market. Are you more or less likely to lose your job at the end of your career and be sort of transitioned at a time not of your choosing into retirement after a big market crash? Of course, the answer is yes. And that's usually the time when retirement accounts are at their most vulnerable. Wouldn't it have been horrible to have seen your industry really contract and to be squeezed out of your job at the end of your career in '08, '09, and then be stuck looking at your retirement without the income from your job with half of your capital that you had so carefully saved and compounded over the years? So it's really, really important to avoid those major drawdowns, and that's what the kind of value that we can offer to our clients and subscribers.
And Bo, now they're only older. So, imagine you've made it over that little hump. You've gotten back from the 2008 correction. And can you imagine now there are even more people that are near retirement. And it's just there's no reason to give back another 30 or 50% of what you have left from that last fiasco.
Yeah, it's like the rain analogy. If you see the storm clouds coming, go stand under the porch. You'll have a much better experience. You might actually enjoy the rain and rather than have it soak you to the skin. All right, so let's get started with our example here because we really want to lay this out to you using real world information, real world data. So let's start with our basic our baseline. So we assume that you start with a $10,000 balance over on the far left side of this chart. If you were to invest $10,000, you would have purchased 133 shares at that level. If you bought and hold, or as we call it here at RBJ, buy and hope, you would have experienced a big upturn, a terrible downturn, a big upturn, a terrible downturn, and then an even bigger upturn. So you've had a roller coaster experience, but you are coming out ahead of the game, and you do have profits. So currently, the S&P 500, as expressed here by this ETF, the SPY, is at $207 a share. So essentially, your $10,000 initial investment would be worth 27,531, which is a 175% gain, which seems pretty good if you think about it. Now let's contrast what would happen if you were able to avoid some of the big downdrafts that the market has experienced throughout this investing lifetime. So the first move up is sort of self-evident. That is the end of the tech bubble and the end of the big bull market that started in the 80s and the beginning of this sort of correction period that we experienced over about a 10-year period. So Roger, do you want to explain what we're seeing on the charts here, what the number one, number two is, and how to interpret that?
Yeah, so one of the things that we focus on is the early signs that things are beginning to shift.
The storm clouds are gathering.
Exactly. Our current market outlook for 2015, we have a situation where the market can climb 5 to 10%. And that sounds like a good thing to want to be able to hold out for. The problem is we are in that zone in which storm clouds are coming in. Anyone who's worth their salt is going to tell you we're in currently a market bubble right now. And that means the risk for a correction of a 15, 20, 30, or even 50% downturn is very high. So just on a gamble,
If it was a coin flip, 50-50.
yeah, 50-50, would you want to hold on and risk losing 20, 30, 50% of your capital in order to make a 5 or 10% gain? That's a bad bet, just to begin with. So it's something to think about. So, well, what do you do? What we would do is we would move into cash and not be exposed to the market if we are going to be playing this from a long-term perspective. What you want to do is to shield yourself from that type of risk. So if we come back here to the beginning here, 2000, the ellipse, the little circle that you see, is reflecting the time period where our indications, where predictive fair technology would have said we're coming into a zone in which storm clouds are coming in and the probability of a significant correction are very high. So that would be the time to really move out into cash and out of the market and shield yourself from that. Who cares what you miss on the upside? It's not worth the downside risk. Okay, I hope that concept comes home to you and makes perfect sense.
That's something really to reinforce because people get very worried that they're going to miss out on something. And it's very uncomfortable for a lot of investors to have a cash position. But it's very important to understand that strategically, being in cash is a position, it's a choice. And if you're able to accurately pick out when the market is reversing, as we're able to do utilizing predictive failure technology, then your best return is to be in cash. Because if everyone else is losing 20, 30, 40, 50%, what's going to happen, and we're going to really illustrate that here as we go through these examples, is you're going to be in the best possible position when prices really get cheap. So it's the old joke. If you liked Procter and Gamble at 50, you must love it at 25. Well, yes, you love it at 25, but you'd love it even more if it was at 25 and you had a lot of cash laying on hand to buy it up when it's at that inexpensive price. And don't forget another thing too. If you're buying investment grade stocks, individual stocks, and now I'm moving away from a sort of an index fund or mutual fund perspective, as the price declines, the not only do you get better opportunity in terms of the capital gains, the price appreciation that could happen in the future, but your dividend yields explode. And that's one of the things that really tends to turn markets once they drop significantly is the dividend yields get to be so substantial that they dwarf the bond market, and people start to move money out of the bond market into stocks, and that's one of the forces that can help to cause a market to reverse out of a very bearish or a negative situation. So there's just nothing bad about having cash when the market's crashing, when the market's in a bear market territory, when people are fearful. The farther it drops, the more leverage that gives you when you make an investment grade type decision to get back involved in the market.
Unfortunately, there's many who really struggle with being able to take that proactive decision and get out of harm's way. So, and that's it's not too far gone if you miss that window of opportunity. You see this little rectangular area. So this is number two. So number one was the early, we want to call it early
Call it,
bird warning.
yeah, call it anticipatory exit.
There you go. Number
When the
two,
risks are so high that the rewards just aren't worth it from a mathematical odds perspective.
exactly. And then now there's the second opportunity to get out is when we get more of a confirmation that says we've absolutely shifted, the market has changed its posture, it's on its way down now with 90% probability. If you didn't get out, it's time to get out now. Don't wait any longer. This would be the waiting for a confirmation, a true confirmation, and that's okay. So there are some of you who need that to occur before you feel comfortable in actually taking that step and moving into cash. But that's still going to be better than not being involved in your investments, letting somebody else handle your money, and allowing that person to say, well, the whole market's moving down. The best we could do is just hold on to it, hold on to the ride. Remember, this is a long-term thing for your retirement, so we're just going to ride that out. That's normal.
Weather
Okay,
the storm, literally.
yeah, and that doesn't have to be your normal, right? That could be their normal, but it doesn't have to be yours. You could say, no, you can pick up that phone. I want to move into all cash. Okay, no problem. And you avoid the significant move to the downside. And then when it's time to come back up and the patterns have shifted again now more favorably and the weather's clearing out and all the clouds are gone away and it's starting to get sunny again and things are warming up differently. I mean, you could tell when you've moved away from the winter and you're beginning to move into summer. There's that little in-between period called spring. And anytime in that season, you'll start to get more and more confirmation that really things have shifted and it's time to get back in, and you can get back in and take advantage of the upside, right? Where the rest of the market has had to hold on and endure through that, which is an enormous waste of time, and we're only getting older, and it makes it more difficult for you to have the kind of retirement that you are capable of having. So
And
one,
and why sit back and breathe a sigh of relief as the market starts to come back and mitigate some of your loss when instead you could be actually making money during that phase?
precisely. See, now look at this. You've got a 50% drop from the peak to the bottom here. With the early bird, you could have avoided easily about a 45% drop. So in other words, that's 45% loss you wouldn't have had to endure. If you waited for the confirmation, you would have avoided about a 39% loss. So again, that's where the rest of the market, the majority of the people are going to have to experience a 39% loss here or a 45% loss here. You can avoid those by understanding that you have information that you can arm yourself with through the innovation of predictive failure technology that up until recently was really available to the public. Okay, Bo, you want to continue with the rest of the examples here?
Yeah. Okay. So let's move forward now to the '07 crash. And again, you're never going to get the very tippity top, and we don't expect to. This is about seeing the change in seasons, the change in supply demand forces. So once again, if you really took the extremes from the highs to the lows, you're looking at a 56% correction. This is a very violent one, as you can see. And our methodology gave us indications again in an anticipatory way that would have helped you avoid about a 53% loss. Now, one thing to note is this anticipatory exit would have gotten you out, and there would have been almost 6 months where you probably felt a little foolish that you got out, and the market was teasing that it was going to go higher. But again, sticking to your to the discipline of what got you here and why you made your decision paid off very nicely as the market then began to break to the downside. So again, we talk about this in terms of premiums, right? It's a little bit like buying a premium product. Well, if you wait for confirmation so that you're really sure that the market has changed its mode from bullish to bearish, it costs you a little bit. So in this example, of the total 56% drop, if you were waiting for confirmation, you can see number 2 there, you were able to save about a 49% drop. So still very, very useful, very helpful. Now let's go back and think about what this really means in terms of actually going through this with real money as an investment experience. And we're going to exclude dividends, so our numbers are going to be off a little bit because you would have been able to get some dividend income throughout these years. But don't focus on the numbers, focus on the concept, because that's really what we're trying to drill home here. So if we assume that we took the most conservative route, we waited for confirmation, we were not aggressive or anticipatory in any way, we would have started out in late '97 with $10,000 invested, and that would have given us a position size of 133 shares. If we waited for that confirmation in the first break, this would have been 2001. Yep, right there. We would have exited the market with $17,000 roughly in our account. So a good profit, nothing crazy at that point. But look what happens when we avoid, in this case, about a 39% drop. The market goes down, it finds a bottom, it confirms that the seasonality is changing and that we're moving back to a bullish environment where buying stocks and holding them makes some sense from an odds making perspective. And this is the thing that's really important to understand. When we make these forecasts that you see either in real time in front of you during one of our demonstrations, or in a newsletter product, or as a private client, these are not guesses. These are not coming out of our intuition or our hunches or anything else. These are really coming from specific, very scientific measurements that we make very regularly in the market. And the more measurements we make, the more granular those measurements are, the more accurate we can be. So the best way to describe this is to think of the difference between an astrologer and an astronomer. An astrologer looks at your star chart, looks at where the different planets are, and comes up with a guess about what is likely to happen in your life. Broad strokes, the predictions are usually pretty fuzzy and not all that practical. Now, an astronomer takes a scientific instrument and a telescope, points it at a specific star, and takes a measurement. Then comes back later on, takes another measurement, looks at the difference between those two measurements, and mathematically determines where that planet is headed, how fast it's going, and even perhaps what mass it has, and other measurements that they can take. It's a very scientific, very clear process. Now, is there some error there? If they think that a certain planet is moving at a certain speed, could it be plus or minus 3 or 4%? Of course. But they're able to be very clear about their forecast for where that planet might be in the future because of that observational process. And that's exactly the process that we go through to let us know objectively where the market is likely to head and how violently or slowly it's likely to move in that direction.
And actually, that's a good point. Let's expand on that just for a second here. So what we're doing is we're not looking for moves the market is likely to make. We are actually measuring and analyzing the probability of the market doing something. So when the probability is high, remember, even if we have a 90% probability that something is likely to occur, there's still a 10% probability, 10% chance it may not. See, so this is not about being right 100% of the time, but you don't need to be. What you need is a high enough accuracy to make the kind of difference that we're talking about here. You just need to be 80%, 90% correct. That zone is plenty. So I want you to understand that concept. Bo, you can expand on it just a little bit, that we are looking at the probabilities and not so much moves that everyone else tends to focus on.
Yeah, and that's true. And a lot of people will be shocked when they hear accuracy numbers, 70, 80, 90%. And the reason that we're able to routinely experience those sorts of accurate levels is because of our ability to stand aside and be in cash and be very, very focused and picky. Predictive failure technology is named specifically for that. There are a lot of very traditional investment setups, situations that have proven over time to be valuable as entry and exit triggers. And those over time have a slight edge, maybe 60% accurate, something like that for some of the best ones. But those too have seasons. For those of you who've read my book, I call that the payback cycle. What predictive failure technology allows us to do is to go into any particular market and look at those signals that are likely to trigger behavior from market participants, and we can objectively measure the odds for success or failure of those patterns. So literally, you get to an area where you might have a topping signal that we predict will fail. Market goes up higher. There's another topping signal that we predict it will fail, and then the market goes higher, and there's another topping signal that we predict will succeed, and that ends up being the high in the market. So most traditional investment or trading methodologies would have taken a few losses as they found their way to the top, or sort of tested their way to the top. We're able to sit back and not experience that drawdown, that pain, that loss, and instead, with a very high degree of consistency and accuracy, offer to our proprietary trading operations or to our clients information that about the odds as to where we are at any given time, and that's very, very valuable information. Okay, so now what I really want you to focus on here is having had a successful forecast, and again, waiting for confirmation means that we're going to take a larger loss than those who are trading in a more anticipatory way. We avoided 39% drawdown. Now the market shifts, it goes back up. Look at what happens here. So our original position, we had 133 shares, and we were able to capture a profit and then avoid a pretty significant multi-year down move. Now, on the upside, because we're entering back in at a cheaper price with more money, we suddenly have a much larger position. So if we were to enter right there at the green line, we would be purchasing about 179 shares. So now every profitable point to the upside is more impactful. We've compounded ourselves moving forward, and that's really what allows us to build greater wealth over the long term. So now we have a nice season. We get a bullish market environment. The market reaches back up. It reaches back up to retest the old highs. There's lots of reasons why retests are substantial and impactful. Really sort of beyond the scope of this training to get into that, but that's a very clear signal of danger. Once again, the forecast that we were going to push lower, maybe violently, was very clear at that point. And again, out of a gross loss of 56%, the anticipatory exit saved you about 53%, and the conservative confirmation exit saved about 49%. So if you exited it at the conservative level, that would have left you with about $23,800. And again, you dropped very significantly after that point. You missed a huge amount of pain and suffering. Now, this time the market was very violent, and it took a while for it to come off its bottom and really confirm that there was a substantial low there. So a re-entry at the second green line there would have put you into a position size of 250 shares. So you see how this is compounding. Not only are you getting more and more money in your account, but every time that the season shifts and it's time to be involved again and an investor, you're getting a larger and more leveraged pushback to the upside. You're making more money as the market returns back to its previous high. Whereas somebody who invested in the middle or the late part of the previous rally, they're not leveraging anything. They're just desperately trying to come back to break even. So now on the third opportunity, you can see there, because people will say, oh, well, those two big drawdowns were an anomaly. We'll never see that again. Well, maybe, maybe not. But what is very consistent is the 20 to 30% correction, which really doesn't constitute as a market crash. It's just a cyclical sort of retrenching and rebuilding, and can often lead, as we saw in this example, to substantially more upside. But there's really no reason to eat that entire move. Here it was just a 21% correction. Again, the anticipatory exit got you out of and avoided about a 17% correction. But even if you waited for confirmation, you still avoided an additional 10% there. So in this case, being prudent actually cost you a little bit, and that's fine. You'll see here that even though you weren't 100% correct on each one of these crashes, the outcome is substantial to the upside. So here we go. We closed out this position with $30,000 in profit. So you've tripled your account, and you'd have bought back in at 240 shares. And if you were to drive that through to completion, you'd end up with $49,680 as a current balance, and that's a 396% gain. So even being super conservative and making the market really prove that it had turned over and was into a bear market or a crash type environment, you still more than doubled the amount of money you would have had at your retirement with that very simple step. Now, if we move forward and look instead at a more anticipatory, more aggressive risk management process, you can see you get leveraged yet again. You start off with 133 shares at the beginning of this investment experience of what, about 15 years. At the end, you would have a balance of $63,342, which is a 533% gain. So you've tripled the buy and hope type investor. And now you've got about 300 shares, 305 shares as the market moves higher, and we move into another one of these anticipatory exit zones. Think of what would happen if we got a 50% drawdown. You'd exit with $63,000 and you'd be buying back at half price, the same asset, the same market, and that would allow you to just keep this process moving forward as you build wealth towards the day that you truly retire.
So, Bo, that's actually a good point here. Let's take this to its logical conclusion. If we're saying that stormy weather is on the horizon, and we decide to go into all cash at this point with what we have, and we basically wait until the market actually does. Well, let's even take it down to here. We can let's pull out the calculator, Bo, and let's figure this out. If the market drops even to 170, let's say.
All right, so we're currently at 207. So 207 minus 170 means that would be a drop of $37 on this particular instrument. And $37 divided by that the current price of 207 would give us a percentage drop of 17.8%.
Okay, so 17.
So that's a substantial correction.
Yeah, so that's pretty healthy. Now, if you come back and buy around 180, all right, right about here, all right, and you ride that back up, what will you have been able to increase the 63,000 to?
Okay, well, if you put $63,000 at work at $180 a share, then that would give you a position size of 350 shares. If it just simply came back to 207, 350 times $207 per share gives you an account value of $72,450. So you can see here, it's kind of perverse in thinking, but you actually tend to make more money by avoiding drops and declines than you do by being there in substantial upturns, because you get this leverage effect, this gearing effect of being able to sell a position near the highs, not at the highs, but near the highs is always our goal, and then being able to buy it back, thus leveraging up and gearing up and the next bullish season that occurs, because there will always be another bullish season. There is no doom and gloom that lasts forever. Sometimes it can seem like that in the moment, but one of the things that's interesting about markets is they tend to crash a lot faster than they go up. So you can just see that on the charts that you're looking at here. The declines are very sharp, very vertical, and the rallies that follow are slow and quite boring and steady. So you actually can, even though it might be painful to be out of the market for a year or two, once the crash occurs, you're going to be feeling very smug and very happy as you are reminded of this video and the gearing effect that you'll be able to enjoy. Now, the thing that's really interesting about this process, again, we're not talking about specific numbers here. Past performance is not indicative of future results. All of those standard disclaimers apply. What we're talking about here is a mathematical principle, which is if you're able to consistently and accurately avoid major losses, it will have a ridiculously leveraged outcome on your profits over time. And the longer you're invested, the more this gearing effect will kick in and the larger your profits will be. And it's important to note that this is essentially a chart of the overall market. This is 500 stocks. So this is a broadly diversified instrument. If we were looking at an individual stock, these moves tend to be a lot more violent, a lot more cyclical, as the individual stories and the seasons that drive any particular stock ebb and flow. And actually, Roger, if you want to just close this window and go back to your major workstation, you can see predictive failure technology is universal. It's not based on one market. It's not based on one particular stock type. It will give you the same sorts of measurements and information on really any asset class, as long as it's traded in a substantial way by a large exchange. So what we do internally for our own proprietary trading, and then we do a lot of consulting for clients and have other products, newsletters, and what have you that allow us to disseminate that information and help other people. You can see all the different markets we go through. So we're constantly getting a total view of the market, and it's a substantial amount of time invested in work. But when you get down to that granular level, you start to see these cycles. I mean, you're not just looking at one little market or one little stock. You're starting to see that all the stocks are coming to the end of their season, and all of the markets are coming to the end of their season. And those sorts of inputs really allow us to move forward and make these kinds of forecasts with a great degree of confidence and really create incredible value for people. Being able to avoid these sorts of common drawdowns and negative experiences, which most people think are just part of part of the pay to play. You gotta be in the market to win. We couldn't disagree more. And again, our careers, which have both been 15 plus years, just have example after example after example of market tops and crashes, both in terms of markets and individual stocks that we were involved in that we just plain didn't have to participate in, and not only could avoid, but we could put our money to work in other markets that were valued or undervalued and ready to turn. Again, just because one market's in one season doesn't mean that there isn't opportunity anywhere else. Look at all these different symbols on this screen. Each one is its own little world. It has different seasons. The seasons aren't necessarily all synchronized, so there's always opportunity in the markets. That's one of the reasons why I love it. It's one of the greatest businesses on earth.
And really, when you think about the concepts, the principles, the philosophy that we've discussed with you today, uh, we're really hoping that you'll walk away with a fundamentally different view on uh, on money, how to make it, but most importantly, how to keep it.
And how important mathematically that keeping process is,
Yeah.
and ironically how much more money that will make you in the end by being conservative and avoiding those terrible drawdowns.
You now have a way to understand how you can take very simple steps towards achieving that outcome.